we've seen the new inflation forecast or projections by the ECB, which do not incorporate already the recent spike in oil prices. So given this recent development, what's your take on inflation? What's the outlook on inflation? And do you think that the projections might turn out to be too optimistic?
Well, two things. First, there is major price pressures now, both on food and on many traded components. So raw material prices in general are rising, not just oil. Oil is particularly rising due to geopolitical risks, and the forward market seems to price in a reduction of oil back towards around about $100. I don't fully subscribe to this relatively optimistic view of the forward markets. They turned out to be wrong occasionally in the past. So I think what we have to take at face value is that there is a genuine underlying price pressure for raw materials and food. That will translate and is already translating in many emerging markets into higher than expected inflation, and that will, through imports, basically also drive prices here. So I think the ECB has done the right thing. They send a clear signal that we're not going to tolerate higher than inflation above our target. And I think the market have got that signal, and I think this was just the right thing to do now.
So all in all, you see some upward risks to the inflation projection?
Inflation risks are clearly up to the upside. I think the projection is based on some mechanical assumptions of normalization, which may not be warranted, as things develop. I see a more genuine pressure on prices than is priced into the projections. At this stage, there is the risk that the economy is stronger than anticipated. We've seen upward revisions of economic activity twice in previous production, and we've seen upward revisions of inflation pressures. And that may happen again. So I wouldn't take these technical assumptions that everything goes back to 2% inflation at a long horizon. I don't take that really as reassurance. It's a technically driven assumption of the models we use, and it's not a reassurance that inflation pressures will cease to exist.
Right now, investors are pricing in interest rates of about 1.75% at the end of the year. Do you feel comfortable with this interpretation of the market?
I wouldn't do anything here to try and correct market expectations at this point.
So you think they are more or less appropriate?
I don't want to correct them.
Okay. So you don't think that markets are getting ahead of themselves?
Well, look, it will not be my decision, or I will not take part in those decisions. So I'm not going at this stage to encourage or discourage market expectations. The market reacted in a way I think that was warranted. The expectation of interest rate moves was put forward in time. I think that was absolutely desired, and I see no reason at this stage to signal any dissent with how markets have priced future policies.
Would you have liked to see an rate increase last week already?
I think we were faring well with giving markets some prior notice to policy action. I think what happens in financial markets is new information needs to be priced in a more subtle way, and therefore surprise rate hikes may be warranted in extreme circumstance. I don't think we were in extreme circumstance. I think to give a clear signal that this is in the pipeline, but it's not on autopilot, it's likely but not inevitable, is just the right signal, because we are still in a period where uncertainties are larger than average. So I think it was just the right signal, it was just the right timing, and I wouldn't want to correct that.
Last question, how much progress have you made with your plan to wean addicted banks off ECB funding, and will you be ready to present the plan at the next meeting in April?
Well, we've made good progress. There are many technical details to be resolved. The biggest technical detail is that many of the country risks and bank risks are highly correlated. So it's not just an issue of dealing with randomly scattered banks that have high demand for central bank liquidity. Those banks are also clustered in certain countries. So it's a double problem, and therefore we need to be a lot more careful with solving both the country dimension and the individual financial institution dimensions, and that will basically warrant a lot of reflection. I think this reflection will continue, and I'm pretty sure by the end of this next quarter we'll be able to deliver some results, but it is a very technically complicated matter, and I wouldn't want to rush things, because it's not just the fate of institution that depends on liquidity provision in the current mode. It's also pretty much clustered on a few countries and may have larger repercussions if we don't consider that second dimension.
So if you don't want to rush it, I mean, it could happen that it will be presented, that the plan will be presented after April.
I would not exclude that.
Thank you very much.